You guys know what is income. Let's just summarize where we are today. We're familiar with concepts of income under Code Section 61. We looked at what's excludable. Got some examples of that. We can compute gains and losses under Code Section 1001. We can figure out what is the adjusted basis, the amount realized. We can figure out what is the character of that income and the consequences associated with that character, right? We looked at all those issues. We saw that there's recapture income, there's 1245, 1250, special rules associated with that. We saw sales between related parties always have their intent out. Whenever there's related parties, Congress may have special code sections at play when there are related parties, and you guys are familiar or gaining familiarity with that. We then turned our attention to the assignment of income, and we looked at various court cases, which define what is the assignment of income in the context of the performance of services and the valid performance of services also with respect to the sale and disposition of goods, right? The first, Lucas v. Earl, the famous fruit of the trade, and the second, the assignment of dealing with property, Ellery v. Horse, right, where someone are assigning interest coupons. Let me just pause for a moment because I do think that it's relevant, and I really think there's going to be an interesting dynamic at play. I don't want to get into the politics of the election because we can spend all night on that, and that's not going to be productive for anyone in this room. But I will share that there is discussion, as you will not be surprised, globally about reducing tax rates, okay? I still think your time here, Monday nights, will be well spent. I hope you don't think that's a shared opinion, because notwithstanding the changes in the rates, does that have much bearing on things that we looked at this semester? Probably very little, right? Because tax rates are something that just gets put into that black box known as your computer, and a different numerical computation. But the thing that, among other things that interest me personally, is there's discussion about eliminating the estate tax, okay? Even though it only affects 5,000 of the richest people in the country, the notion is somehow if we get rid of it, it will create massive job growth, which don't ask me how to correlate the two. But having said that, just pause for a moment and think to yourself, what would be one implication if the government did, and there's a lot of movement in this direction about eliminating the estate and gift tax, okay? What might that impact greatly? Something I just raised. And let me fill in the blanks because time is not going to be our friend tonight, is without a gift tax at play, any gift tax, there's no friction to stop people like us or people like your clients giving gifts to their children and saying to their son and daughter, hold on to this for appreciated asset for 6 months. There's a lower capital gain rate that applies to you, okay? And then once you sell it, wait another 6 months and gift it back to me, right? What's to stop people from doing that legitimately, right? And you could say, well, the government could invoke Susi Salvatore, right? And say, look, that's a sham. You really can't do that. But does the government, and in particular, does the IRS have the resources, right, to police people making those transfers? And the answer is absolutely categorically not, right? So I don't know if the government could willy-nilly just simply revoke the gift tax. It could revoke the estate tax, but in the absence of a gift tax, the progressive rate structure could be in real jeopardy, and that's epitomized, right, by chapter 12 of our textbook about the assignment of income. All right, so I'm just giving you some things to think about, which may come into play, for, today, tomorrow, next month, next year. But just be aware. Don't let it be said. This may not be the last time you hear it. Okay, so we then looked at chapter 12, the assignment of income. And we moved on, and we started talking about business expenses, right? And we talked about code section 162, which started us all off with ordinary and necessary expenses. And what the authors of our textbook, if you recall, what they wanted to do was open the door to code sections 162A1, A2, and A3. They also drew attention to code section 263 and the capitalization rules. Code section 262 with respect to limiting personal expenses. But again, they outlined for us code sections 162A1, A2, and A3, dealing with what are reasonable salary expenses, travel expenses, and lease payments, right? Lease and rental payments. And gave us an overview. We saw, for example, that ascertaining what is legitimate or what's travel away from home is not always easy, right? To put our finger on. And we looked through court cases, we looked at the Treasury regulations, we looked at the limitations, right, under Code Section 274. We saw 274C, when it comes to foreign travel, that unless one of two exceptions are met, that only a portion of the travel expenses may be deductible. We looked at 274H, for example, dealing with travel as a form of entertainment. We looked at business expenses with meals, right? Business meals. And we know under 274N, there's a 50% limitation, right? So you first, bear in mind, we first have to meet Code Section 162, right? It has to be ordinary and necessary. Only if it meets that requirement, being an ordinary and necessary expense, does it possibly get further limited by Code Section 274, right? So you can't invoke 274 without crossing the line on 162 as being legitimate, ordinary, and necessary business expense. And then the authors walked us through, and they spoke about educational expenses under 162-5 and how to characterize educational expenses, which ones may be deductible, which ones aren't. And then they took a hodgepodge of different expenses and examined, for example, lobbying expenses, uniforms. Needless to say, just like the authors couldn't give us and walk us through every exemption in the code, because we could spend the whole semester talking about exemptions. By the same token, the authors can't walk us through every business expense, right? Bear in mind, when it comes to travel and entertainment expenses, you have to give substantiation. In yesteryear, under what was Cohen v. Commissioner case, a case I've written a fair amount about, is that you could in yesteryear make estimates of your business, entertainment, and travel expenses. Now, under Code Section 274D, right, it's a legitimate expense, presumably under 162, right? But 274D says if you don't have the necessary substantiation, you can't estimate those expenditures, all right? So you got to bear that in mind. Again, you see the give and take between 162 and 274. So we went through a large part, not the entirety of Chapter 14 in our last class. And what I said that the focal point of today would be examining depreciation expenses and walking us through the nature of depreciation and how that's operative. And then towards the end of the class, maybe we'll have a half an hour, maybe an hour, depending on how quickly we go through depreciation. We'll start talking about expenses of a different nature. What nature? Chapter 15 opens the door to what code section are you going to add to your ever-growing repertoire of code sections? And I know, Jessica, you're at the edge of your seat. Anxious to tell us. You know what we're talking about for next chapter? What code section?
For depreciation?
No, that's for this chapter. For next chapter.
212.
212 expenses, right? with Louis, what kind of expenses are those?
Non-business or profit making.
Okay, if I can put a label to it, labels are important, labels help grasp information. Investment expenses, right? People incur all sorts of expenditures trying to make money, not through their trade or business, but due to their investments, right? And Code Section 212 examines which one of those expenditures are deductible, right? All right, we got that? So 162 looks at trade and business. 212 looks at investment expenses, right? And we will look at 212, 1, 2, and 3 towards the end of class for sure. Just so we get placed, so you guys, before we blink, things are quickly coming. We're almost see the checkered flag at the distance. Next class, in case anyone has to leave early, you will finish chapter 15, okay, that deals with investment expenses. And we will begin to go through chapter 19. Chapter 19. And towards the end of this class, I'll try to give you a heads up on how to read chapter 19. All right? Chapter 19 deals with a 4-letter word. Okay? It may not be the 4 letters you're thinking of. All right? Luca, do you think you know the 4-letter word chapter 19 deals with?
Time.
Time is appropriate, but when? Time, when. As opposed to, if you recall, chapter 12 dealt with the 3-letter word who. Okay? Chapter 19 deals with the 4-letter word when. All right. Before I start, any questions substantively on material we covered? Any questions logistically about the next few weeks?
The final exam is going to be 2 hours and 30 also?
It's going to be probably 2 hours and 45 minutes. It's going to be a bit longer, a little bit more weight. Those who are searching for redemption, if you need it, I don't know if anyone here needs it, but there'll be that opportunity to hopefully perform as well, if not better, on the final, and accordingly get calibrate a higher score.
Those same structures I found.
Same structure, a bit longer, more questions, more fun.
You're taking the open-ended part away from us after an hour.
Yes, certainly. Go ahead.
Cumulative, right?
Cumulative. Largely on the second half, and so I can really get your attention for tonight. Everyone ready? Lots of questions on depreciation. Okay, so everyone's caffeinated tonight. Okay, and I don't know if that bottle of water is going to cut it. All right, I am anxious, ready to go. I am juiced up here. All right, I'm hoping you guys have that same. All right, I am always kind of juiced up. All right, you guys ready? Depreciation? Let's see. All right. If I was an MC at a wedding, I would say, "What was that? Did I hear it that way?" And you guys would be louder, and then I do it one more time, and I won't do it again. All right, but I'm thinking it. All right, depreciation. All right. Let me, and you should have open Code Section 167 and 168. Let's start with 167, but let's just face the fact, why is there depreciation? Why in the code is there depreciation? Because in theory, taxpayers could purchase assets, right, and simply expense them immediately, right? And by the way, when I teach this course next year, I may be having that conversation with students and saying, well, that's in theory you could, but there's a fair movement in Congress. And again, given our new president, among other things, there's a discussion about it, is perhaps that there would be no depreciation under the Trump approach and Paul Ryan approach, that you would simply expense everything, okay? And then you would take immediate deductions. Nick, you're going to say?
That'll mess with people's books too much, though. I
mean, that'll make you.
Why, it's just sort of tax books.
And you can only, I mean, if the government will give you a refund, you can only deduct up to your income.
Remember, Donald Trump had 19
Well,
billion.
you got to carry it. Yeah, 90 billion or.
900 million, you just have an NOL.
So you can continue to carry it.
Code section 172. I mean, again, guys, that's not for tonight, that's not for the exam, that's just in theory. I want people to be aware of where this may go. I'm not saying it will. By the way, historically, I never test people, but 1981, to give you a little historical bearing, Ronald Reagan tried this, okay? The then Republican administration tried what they called accelerated acres, okay? Accelerated cost recovery, which was nowhere close to, it was just very compressed write-off. It was not complete write-off. It cost the Treasury so much money, there was such hemorrhage of revenue that the government wasn't collecting anything. So they had to reverse cut the track within a year because there looked like we were going to have spiraling deficits and all sorts of craziness. So it didn't work in 1981. I'm not so sure why it would work in 2017. But that's a good way for me to segue. In 1982, they had to institute makers because they were so desperate to limit the hemorrhage of revenue from 1981. Makers modified, right? This weekend, you can talk about makers, right? Modified accelerated cost recovery system. And its heritage is in the debacle of the earlier legislation, acres, which didn't fly. Okay, so now we have modified because the acres was just too generous to taxpayers. All right? But conceptually, everyone who's had GAAP accounting knows that, you know, an asset that is a piece of machinery, right, the 1231 asset, lasts for several years, produces income over those years, and you want to have this matching principle that, hey, the first year you buy the asset, it's not a wasted asset, it's going to still produce income over several years, and it makes sense to take it over, depreciate it over its useful life. And this is spelled out by the authors in the introductory pages of why there's depreciation. In Code Section 167A is the old system, and it talks about that if you're allowed depreciation for property used in the trade or business or property held for the production of income, the latter of the two, production of income, is Code Section 212, right? Property held for the production of income. And what comes to mind, is rental income. For example, if you own an apartment building, it may not be your trade or business. You may just be renting, right, the building. But nevertheless, you're entitled to depreciation, right? Okay. So, what I think is useful here, albeit the authors go through several different code sections here, or they spell things out. Let me just take this opportunity to walk you through Code Section 168 and highlight those facets of it that I think really are important and that you shouldn't miss out on. So if you have Code Section 168, so 167 is sort of there for historical purposes, just talking about when is depreciation allowed, and it talks in 167A generally. 167A. 168 says, A, except as otherwise provided in this section, the depreciation deduction provided by Code Section 167A for any tangible property, okay? In contrast, just make a mental note, or should maybe in your notes, not a mental note, maybe a written note. Code Section 197 deals with intangible property, okay? 167 deals with, 168 deals with tangible, 197 deals with intangible property, okay? Everyone got that? Two different code sections at play. The thing about depreciation is that it's extraordinarily mechanical. In contrast, for example, to Chapter 12, where we were dealing with sort of the ether of, well, did they assign the income? Can we evoke this judicial doctrine? Can't we? With depreciation, it's formulaic, okay? It's not like we're gonna have to guess. And for exam purposes, make sure you bring a simple calculator, okay? Unlike the midterm where you can sort of add and subtract in your head, I will ask numerical computations, okay? Of what is the depreciation the first year? What is maybe the depreciation the second year? What is the depreciation the last year? You're gonna have to play, the mathematics will not be complicated. It will be a matter, in most instances, if not all, of probably multiplying 3 numbers together, sometimes just 2 numbers, okay? I think everyone in this room can handle that? All right, good. Now, the harder part is which 3 numbers, right, if I ask you that question. And what the authors are going to point out to you is that the 3 numbers are generally spelled out in 168, 8, 1, 2, and 3. Those are generally the 3 numbers. You know these 3 numbers, you are good to go. Okay, so let's look at them. You need the applicable depreciation method. You need to know what that method is. What is the most popular, Edward, what's the most popular depreciation method?
Straight line?
Is that true, Stephanie?
Not sure.
Dick?
I believe there's an accelerated method that's a little more popular, straight lines.
Well, what does accelerated mean? Say it.
Is it double declining?
Edward? Well, for certain, let me say you're right or wrong, Edward. I don't know if that's good or bad.
Okay.
The most popular method for most property is double declining. Okay, 200% double declining. But when it comes to what property, Nikisha, must you use straight line?
Tangible?
Is that right, Kaya?
I would say it's like buildings.
Stop there. Buildings, real property. You must use straight line. Okay, everyone got it? So, in general, you use 200% double declining, but with buildings, you use straight line. And with respect to certain property, which is spelled out, where it's 15 or 20-year property, you have to use 150% double declining, okay?
What?
If you look at code section 168B2, 168B2, when it comes to 15 and 20-year property, you have to use 150% double declining. All right? Notice under 168B1, B1B, at some point, even when you're using double declining, you're going to have to switch to straight line. Why? If you keep using double declining, you'll never get to 0, right? So the code instructs that you'll get to use or have to use whichever number is larger, double declining or straight line, whichever produces the larger depreciation deduction. You'll see when we go through some examples, just pulling this to your attention. Okay, and then it points out under 168B3 when you must use straight line. Salvage value, unlike GAAP, for our purposes, tax purposes, salvage value always treated as 0. Okay? Always treated as 0. And under B5, taxpayers can, I've never met a taxpayer who has, taxpayers can elect straight line method. Okay. For exam purposes, I would always tell you, you'll never have to search, I promise, for what is the class like. In other words, in an exam, I would tell you, if you look at code section 168E, skip over to 168E. 168E says, in general, except as otherwise provided in this subsection, property shall be classified under the following table. Notice to the right, it says, if such property has a class life in years of, okay, everyone see that? I would tell you what the class life is, because once I tell you the class life, then you can look to the left and figure out how the property shall be treated. Everyone agree? So if I say the class life of property is 9 years, how would you refer to that property other than? Everyone agree? 5-year property, right, Nick? Do you see that?
Oh, yeah.
And then you could turn to 168C and know that in the case of 5 years, the recovery period is, here's the shocking, 5 years. So we got 2 out of 3. Everyone agree? Under 168A1, we have the applicable depreciation method, which comes in several flavors, right? 200%, 150, straight line, right? We have the applicable recovery period. Because I would tell you for exam purposes what the class life is. If you were in general practice, you could easily look it up. If you had property, that's easy to find out, but you're not going to have to go through that. So we got 2 out of the 3, right? We have 168A1 and A2. Everyone agree? Everyone can get the first 2. Here's the third, and this one challenges people. People get challenged on the third. They either don't apply it correctly or they forget to apply it. Okay, so in the years past, hopefully this doesn't befall you, the two mistakes students commonly make is 1, they forget to apply a convention. That's not good because the code requires that they apply a convention. Or 2, they apply the wrong convention. Well, that's not good either. So you got to make sure you apply a convention, and you got to make sure you apply the right convention. Everyone agree? That's critical to your success here. And conventions are like Baskin Robbins. They come in lots of flavors. Okay, so you got to make sure you get the right flavor. All right, it's not all vanilla. Sorry. All right. All right. So, Katie, what's the most common convention? No, sure? Ashley? Felicia? I'm saying.
No. I'd say the half-year.
Yeah, half-year convention, okay? Half-year convention is the most common convention. Meaning, if you put property in January 1st, doesn't matter, you only get a half year the first year. You put it in, say, September, late September, while the song's written about September, not about depreciation, maybe depression, not depreciation. Get a half year worth of depreciation. Warning sign now. Warning sign. If you put property in the last quarter, okay, if you put property into service the last quarter, and more than 40% of the property you put into service for that year is in the last quarter, you must go on the so-called mid-quarter convention, okay? I repeat, this trumps the half-year convention. If you put more than 40% of property into service during the last quarter, you must go on the mid-quarter convention. And I'll go through some examples momentarily. 2 other conventions you have to know about. So we have half year, mid-quarter, and then, Jeff, what other conventions do we have?
Mid-month convention?
Mid-month. When does the mid-month convention apply, Jeff?
Bonus?
Say again?
Bonus?
Bonus depreciation.
Well,
But
what
that's
kind of
not
property?
convention.
Real property?
Real property, right? So mid-month convention applies to real property. And finally, we have one other convention. The other convention applies to intangible property. Intangible property is the full month convention. Full month convention. Four different conventions. All right, just get our feet wet for this. Let's just make sure you know your conventions, or at least did everyone bring with you this sheet? I actually printed out some extras just in case you didn't bring it. So I have 10 extras. Let's see if we can keep the count below. So if you haven't got it, you can run up here and I'll. I don't know if we're going to have enough. So first come, first serve. Everyone's racing down.
I have it on my phone.
Okay. Sorry about that. I can give this one after you just come up after.
Okay, yeah, I mean,
All right, let's talk about the mid-quarter convention, guys. Make sure you guys can handle this. We'll look at examples of the full month convention, mid-month convention, and half-year convention. But look, in the operative numbers, keep in mind, are four. They're at the very top. 10.5, 7.5, 4.5, and 1.5. Okay? Let me just let's take one example and then we'll go from here. Ignore the example that I have here. Just suppose someone buys a piece of equipment, 5-year property, valued at $200,000 in the year 2016. Okay? Or 2015. 2015, someone buys, how much depreciation do you get if someone purchases in February one piece of equipment worth $200,000? One piece of equipment valued at $200,000. You want to come up with a number? Everyone try it. See if you come up with a number. I'll try to keep my mouth shut for 30 seconds. Everyone hopefully working out some numbers. We'll right grab them. Busto, you have a number?
Yeah, I use labor depreciation.
Just say it loudly.
I use labor depreciation, and I got 4,487.
4,000, how much?
487.
487. Alicia?
No, I just started my.
You just started? Meta? You don't have it? What we're doing is buying one piece of equipment worth $200,000 in February. What's the depreciation? John?
still working on it.
Still working on it. David? Matt? Don't ask me, I'm just the client. How much? 20? Diana? All right. Evelina? Nick? Jessica? Mike? Got a number?
It's like 38.
Les?
35.
How much?
35.
35, Luca? All right, guys, let's just run through it. What do we start? Busto, I'm just going to listen. What are you going to multiply?
Well, I took 200,000 and divided by 39.
Why did you divide it by 39?
Because the years the asset that you placed in the
Well, but it's 5-year property.
it's 5 years.
So it's 20%, so it's 40%. It's 40% of that.
But then you take half a year.
All right, so it's 200,000 times what? All right, guys, let's be kind of boring. Everyone, we ready to be boring?
Please.
All right. We look at 168, and we have to apply A, 1, 2, and 3. Right? Everyone agree?
Yes.
What's the applicable depreciation method in this case, James?
Double declining.
Here.
Say it loudly.
Double declining.
So what would I multiply here?
200%.
200% times what? GA? What would I apply it against?
I'm trying to get a paper.
Just say it loudly.
I'm trying to get a paper online. I don't have this.
You don't have a line. Jackie?
I'm not sure.
Luke? Jeff?
40%
40% times what?
times 200,000
Where did you get 40%?
is twice two. It's double 20%. It's 5-year life.
Well, isn't it a 5-year property, which is 1/5 times 2, which is double declining, right? Everyone agree? So we have the applicable depreciation method. We have the recovery period. The recovery period is 5 years. Depreciation method is double declining. And the convention. Half year. Everyone agree? So that equals how much? Ron, you good? Right? Guys, it's 5-year property, which is normally straight line, but it's double that, right? It's 200%. But we're instructed, because it's the first year, to use the half-year convention, right? That's simple depreciation. You must. Well, you don't have to do anything, but if you want to make my holiday better, and then I'll say parenthetically your holiday better, you must know this. If you don't, you must ask me, because this is something you're going to see again. All right, you can't do this, you're not going to be able to do 10, 15% of the exam. All right, you're going to have to do simple depreciation computations.
What's gonna happen in year 2?
Well, what would happen in year 2? Tell me, what should I multiply? Don't tell me. Take 30 seconds, everyone come up with a number for year 2. Take 30 seconds. Joanna, you got a number? Louise? Just say it loud.
32,000?
32,000. Louis?
64,000?
64,000.
64 too.
Got it?
64.
Keisha?
I'm going with 64. That wasn't my original answer, but now I understand why it's 64.
Okay, Edward?
Same thing.
Nick?
64.
Hey, Nick, how did you get that? What did you multiply?
I took the difference, 160,000 times the
Okay,
one.
double declining, meaning you took the difference.
Yeah, I took the 40,000, subtracted from the
Right.
water. So I got the 160 times the
2
1/5
fifths. 2
times
fifths.
the 1/5.
2
Well,
fifths.
times 2/5, double declining.
Well, then I
Second
times it,
year.
and then I multiplied it by 2.
Right, okay, same thing.
It's the same thing, that's why I did it. I did it, and then I multiplied it by 2. Instead of the 1/5, I did 1/5 multiplied.
Okay, we'll get this.
Same thing.
And the answer is?
64,000.
64,000.
Everyone got that? There's no half-year convention, right? In year 2, you don't apply a convention. That's only in the year that you put it into service and the year you end. Okay?
All right, I got it.
You got it now? Stephanie, problem? You good? All right, you guys are good on basic straight line, basic depreciation. You ready to do mid-quarter convention? All right, so with my handout. Louise, you got that? Just say it loudly.
Can you just quickly say for a year, will it be 3 over 5?
No, it's not going to be over 5. It's 64. We would have 94,000. 96, excuse me, long night, times 2/5.
Because it's 1 times 2.
Yeah.
Same thing. Okay.
Will that be 3?
Whatever that number is. All right, mid-quarter convention. Mid-quarter convention. You look, we have Silver Corporation acquired the following 5-year class property. 3 different properties, right? The first one was acquired in February, worth 200. Second one in July, 400. Third one in December for 600. Everyone see? Notice, did we put more than 40% of the property in service in the last quarter?
Yes.
Yes, everyone agree? Therefore, we triggered the mid-quarter convention. So, what's our first year of depreciation? How did the number 70,000? Can everyone tell me what was multiplied to get the number 70,000? Okay, tell me what was multiplied together to get the number 70,000. Don't say it out loud. I'll call someone in 30 seconds. Figure out how to get the number 70,000. Here, what number do you have?
I'm not sure.
That's right, Tarina?
I'm not sure.
Ashley?
I'm kind of confused. So, why are we looking at the February one again?
Why are we looking at it? Because now with the mid-quarter convention applied. When we first did these problems, it was just one piece of property. Okay?
Oh, then it was.
Now the mid-quarter convention applies, right?
So that has to apply to all of them?
It will apply to all 3 pieces of property. And what we're going to notice is, instead of this half-year convention, we're going to take 200,000, right, times 2/5, right? That's 200% double declining, times what? The convention has changed. When was it purchased? February, the first quarter is 10.5 over 12, right? We have a choice when it comes to mid-quarter. The numerator can be 10.5, 7.5, 4.5, or 1.5. Everyone agree? Those are our choices. And it's right here at the very top. And guess what this comes out to be? 70,000. The property purchase in July will be 400,000, right? Times 2/5, and it was purchased in, was it the first, second, or third, or fourth quarter, guys? When is July 10? Third quarter, which is, what's the numerator? 4.5 over 12. So that should give us 60,000. And what do you think happens in December? 600,000 times 2/5 times what? 1.5 over 12, which will give us a yield of 30,000. Everyone see this? The numerator changes depending on which quarter, right? Okay, let's see how good you guys really are if you're just nodding. All right. All kidding aside, Edward, you got this? Did you miss something? You good? You got to know this. So even if go with me on this, but after class or this weekend coming up. Okay. Last part of the problem says assume the same facts as above, except that Silver Corporation sells the 400,000 asset on November 30th of 2016. Okay, everyone see we're going to sell. Now, that's the middle asset, right? Everyone agree? What's the depreciation for this asset? Let's say the 200, let's call this asset A, B, and C, okay? A, B, and C. What's the depreciation for asset A for next year? And how do the authors get 52,000? How does that computation work? What would you multiply?
130,000.
Right? 130,000 times what?
2 5.
Times 2/5, right?
Yes.
It's 1/5 double declining. Everyone agree? And how did they get 600? How about the December asset? What would you multiply together? How would you get the depreciation for this asset, the asset C?
Well, then it would be the same as the difference.
You take 570, right? Times 2/5. You guys are good. All right, now we get to the tricky stuff. All right, everyone see those two for asset A and asset C, right? Just double declining. And once we are done with the first year, we don't apply the convention again. Agreed? Just use your normal double declining. Agreed? Asset B is sold during the year. Okay? Which means if an asset is sold or it's its final year, you got to use whatever convention you use going in. Must be the same convention going out. Okay? Whatever convention you use going in must be. So we have to use the mid-quarter convention. So what are we going to multiply? We're going to multiply what? 340. Everyone agree? Times 2/5. And what are we going to multiply here? I can help you. We're going to leave it to one number. Denominator is 12. So the big issue is what's the numerator? Okay? Luke, what is it?
4.5.
4.5. Jackie, agree?
Yeah, I'm not sure.
Not sure. Tina? You're whispering.
Yes.
Alicia? Stephanie? Keisha?
I'm lost.
Yeah.
Sorry.
What are you lost by? Articulate it.
Put it in words.
I don't, I understand how to do a half year and a mid-year. We were good with that, but once we get to when you're selling it, how do you determine?
Well, we didn't come up with an answer, so you can't be confused yet.
Oh, okay, all right.
But you're using this.
When was this, how many months was this piece of equipment?
It's being sold in November. It says right here, sold November.
11 by 12.
So 11 by 12.
What?
11 by 12 because it wasn't used for 11 months.
But it's
All right, we
mid-quarter.
go slowly. What's your question? I don't understand your question.
Should be 11 by 12.
Okay, I think I have an answer.
So I was like.
What's the numerator? These don't have a convention because neither property A and property C were not sold.
10.5.
There's no convention. Alicia, you got it.
Is it 10.5?
It is 10.5 over 12. Why? Because we held it towards the fourth quarter, and notice we're flipping it. This is 10.5 over 12. When we purchase the property towards the end of the year, there's not much of a year left, right? Everyone agree? That's why we got very little depreciation, 1.5 over 12. If we sell property towards the end of the year, in this case the fourth quarter, you got to flip the numerator. So it goes in the exact opposite order. And where we purchased the property in February, notice how, right, there's a lot of months left, right? So we should get a lot of depreciation that first year. But the converse is true when you sell property.
So let me ask something. If we add 1.5 plus 10.5, then we have the year?
Why are you saying 10.5 plus 1.5? We know. I mean, in this particular case, it's whenever they sell the property, that will dictate the numerator of the convention.
November.
What?
It was sold in November.
It's sold in November, which is the last quarter. But they've held it, right, for all 4 quarters. They held it January, February, March, April, May, June, July, August, September, October, November. They've held it a lot. That's why the numerator is so large. If they sold the property in January, it would be 1.5 over 12. Right, please? Makes sense? They sold it in the first quarter.
I would use 11. not
If they sold it, hold on, you would use what?
11 instead of 10.5.
What? Where do you get permission to use that? You don't.
11 months.
But there's nothing in the code that permits you to do that, Louise. The mid-quarter convention demands that you use 1 of 4 numbers.
Oh.
This is not Jay Solin's method that I just chose. I like those numbers, my favorite number. All right? You don't have options here. Now, Louise, if this were intangible property, under Code Section 197, you use the full month convention. And you would be right if this was an intangible asset you were selling. You use the full month convention. So if you purchase property in January or February, let's suppose you purchase intangible property in February, you get 11/12 of depreciation for the year. It's the full month convention. Wes?
Just a quick question. So you bought property, you bought a piece of equipment in July for $400,000, and you sell it next November,
Right?
how are they intentional about here?
Because it's the last quarter. And you're taking, remember, the quarters I defined up here, which is straight from the regs.
Yeah.
You have a choice of 10.5, 7.5, 4.5, or 1.5. And this is just the opposite of when you put it into service, you're taking it out of service. Depends on when you're taking it out of service.
Okay, thanks.
In this case, it's the last quarter.
In this example B, 400 multiplied 2, that's multiplied 4.5, not 5.5.
Again, it can't be 5.5. It's got to be one of the 4 numbers I told you. Okay? Got it?
Oh, I see, I didn't see that.
Okay? It's not the mid-month convention. It's not real property. Ashley, you had a question? All right. So, mid-quarter convention, again, guys, conventions are things students often miss. They either forget to apply, or they apply the wrong convention. But you've got to know, you want to do well, I want you to do well, you got to know which convention to apply and when. Matt?
If it was sold that same November.
So say it loudly, if it was sold when?
That same November of the same year they purchased it. Would it be
That gets funky.
Okay, so.
I mean, what Matt is saying, what happens if they acquire it and sell it in the same year? Okay? I have to think about that because I don't know myself. I've never had a client purchase and sell property in the same year. Right? You will not see that in the exam, okay, Matt? So fear not, okay? Wes?
So real quick, you're just taking the 12 and minus the 1.5.
I'm not taking the 12 minusing the 1.5, okay? Truly not. That it's just 10.5 over 12. It's sold in the last quarter. That's the convention. I'm not backing out 12 minus 1.5. Okay?
Well, you're selling it in Q4, right?
Yeah.
And it says in Q4, it says Q1 it's 10.5 months, and you're using 10.5.
Well, what?
It's swapped when you sell it.
When you sell it, yeah.
Right, you just,
Where are you looking, Wes?
no, I'm just on your list.
Oh,
on your
okay.
list here.
All right. So look at this, and if you have problems or you're getting stuck, let me know. All right? Because this is stuff that and look, you want the truth? Here's the truth. If you do this for clients, chances are your computer is going to do it, you're going to enter it, and your computer is going to spit out a number. But I need you to know why the number is maybe a lot less than your client says, hold on, why aren't I getting the full year of depreciation? The client says, oh, why am I getting less than they anticipated? Or maybe they're going to get more than they anticipate. You can't just say, well, that's what the computer tells me, and I just go by the computer. That doesn't, you don't sound very professional, right? So you got to be able to articulate, hey, there's a mid-quarter convention applies. These are the numerators and denominators, okay? So I just need you to be, I want to put you in a position you can have a meaningful conversation with your client, okay? That's my objective. Louis?
So once the piece of equipment is more than 40% just in your final quarter, the whole thing goes back to this.
I'm not sure what you mean the whole thing.
Like like all your equipment, like you bought throughout the year.
All the
goes-
property you put into service
goes
that
to
year
your-
for that class of property, so on the mid-quarter committee. Okay, why? Congress doesn't, let's think, right, and Mike, I'll get to your question. Why did Congress stick in the mid-quarter committee? From a policy perspective, why does the mid-quarter exist? Why? Because Congress was fearful. You remember Subsection 1014E, where you had a dying person and someone gave a gift, and 1 year later the person died, within 1 year and gave it back. Sort of that, and Congress said, boy, you're playing games with stuffing that person with property, and they're going to give it back to you. Similarly, what Congress is fearful of is that a lot of companies and businesses would stuff property in the last quarter, let's say December 31st, and hope to get a half year's worth of depreciation, where they only had the property for 1 day. All right? So this is a, half year sort of, well, half the country puts the property in early, the blue states and the red states put in the second half, but we're all one country, we'll just split it, half and half. But when there's a different objective going on, whereas this stuffing objective, right? Congress is concerned, that's why we had the mid-quarter convention. Mike, you had a question.
Oh, just like if you did it from one date to another, would it be August 15th to November 15th?
I'm not sure what you mean. You do quarters, it's every 3 months, it's not the 15th.
Oh, it's not going to the middle of the quarter?
It is, so I'm not sure what your question is.
So for the $400,000 one, your start date would be August 15th for the middle of that quarter?
Which one?
For the one that says
January, February, March is first quarter. April, May, June is the second quarter. I'm not, so what's your question?
So then it's July, August, September, so August 15th is your date where you start the...
I don't know what you mean by start.
Like where you start to accrue the depreciation.
When are you putting it into service? You can put it in any time during that quarter.
Okay, and then what date do you use?
I'm not sure what you mean what date. You automatically use the mid-quarter convention. Doesn't matter.
Regardless.
So just take your number from the thing based on the quarter?
It will be one of those 4 numbers, will be the numerator, based on when you placed it in service.
Okay.
Period. Okay, Nick.
I just want to ask you about the first problem up there. Why is that 1/5 and not 2/5?
Well, it is. 1/5 times 2 is 2/5.
Oh, okay.
Okay, so
Math isn't my
That's an
strong
easy
suit,
one.
so.
No, I was going to say, for that last problem with the asset was sold in October.
Just say it loudly. Fusto is asking if the property was sold in October, yeah?
Would it be 9.5 over 12 with convention?
No. The last
It's
quarter.
the last quarter is
$10.5.
7.5. I'm glad your peers in the class are just as adamant as I am. 10.5. James?
To answer the question, you can't take depreciation if bought the same, bought and disposed in the same year.
I don't know, James. I've
No,
never
you
had a
can't.
case, so again, you're not going to see that on the exam. You're saying you can't? Is that, where is that in the code?
I don't know about the code, but I remember looking it up where.
Okay, so just, I'm going to say this with tentativeness. Wes, or James reports, if anyone wants, I'd be curious, that if you bought and sold in the same year, you can't take a depreciation deduction. Maybe during the break, I have strange ways of entertaining myself. I will see if I can quickly get a code section or some authority for that. Let me see if I can remind myself and run upstairs. Wes?
So if you sold this in Q3, you'd be 7.5.
If we sold it in when?
Q3.
Q3, I like it. Q3 would be 7.5 over 12. Yes.
Yeah.
You're ready for a cocktail party.
Yeah.
All right, any other questions?
Can we finish that out real quick?
What do we finish?
Calculations real quick, that's all.
I mean, I'm assuming the numbers will just play out just.
52,000.
Yeah, just the numbers here. 52, 119, and 228.
Gotcha. Okay. Oh, okay, it's right there. Sorry.
Okay? All right. Say it loudly, Anna.
So we have 200,000 times 0.26. I just want to understand the 0.26.
Don't worry about the 20. This all comes from a table. And there's tables that are available. So when you see the 0.26 in my example, this is from a book where they're applying tables. But I think it's much more effective to see where the tables got their 0.26 from.
Okay.
All right? So there's all sorts of depreciation tables. But I think it's easier if you don't even use the table and you just figure out the numbers yourself. It's harder to find a quote-unquote right table. All right. So, guys, it's very mechanical, right? You have these three things. You can figure out the appropriate depreciation. Once you know the depreciation, you guys have been there, done this. Guess what happens to your basis? Under Section 1016, it gets adjusted downward. Okay? It's adjusted downward. Do not, you have a lot more to worry about. On page 436 is a discussion of anti-churning rules. Do not worry, you will not be tested on the anti-churning rules, okay? Do not worry. You will not be tested on it.
What page?
It is on page 436. 437, I'm sorry, the anti-churning rules. I'm not going to apply it. Don't have to worry about that. Depletion is very similar to this concept of reduction of basis. So we don't have, if you're in an oil country, we talk about depletion, but we don't have too much oil in New Jersey and New York, so we don't have to worry about depletion. On page 438, there's Sharp v. U.S., which is a good case, okay? Sharp v. U.S. Not a hard case to follow. I like this case. It's not a hard case to read. Anyone want to take a stab at it? Was that you, Nikisha, had her hands up first. I heard the smile.
She's always.
So,
And Luca, jump in if you have some thoughts here. Nikisha, what happened?
there's a partnership, Sharp and Sharp, and they purchased an airplane. The airplane that they purchased, they basically tried to depreciate the entire amount on their tax returns.
All right, let's slow down. Let's slow down. They bought a plane, they made improvements, which caused the basis to go up. Everyone, no one's going to flip out about that, right?
Yes.
They bought it for about $45,000. They make $8,000 worth of improvements.
Yes.
basically, they have a tax basis from the taxpayer's point of view. They say that 54,273.50, and they take depreciation deductions of 13,777.92. Their basis in this property, they claim, is 40,495.58. Okay, taxpayer's position. Now, I don't think, if I recall correctly, Nikisha, I don't think the government argued that the taxpayers took too much depreciation. That wasn't an issue here, because how much was business use, how much was personal use of this plane?
73% was personal use, 26% was business use.
Okay. 74% approximately was personal, 26%, you know, the difference is going to be considered 26% or so going to be considered business use. So everyone pictured on personal use of a plane, can you take depreciation deductions?
No.
Everyone agree? No depreciation deductions, right? If you own a plane that you just buzz around with for fun, no depreciation deductions. Agree? Agreed. You can only take depreciation with respect to, by the way, I want to give a shout out here for Fusto. You're drinking what? He's drinking a Monster, right? He's taking his depreciation very seriously. All right? So during the break, enough of the bottled water, guys. Just keep that in mind, okay? So he is, so with respect to this plane, from the IRS perspective, they're going to say, gee, there's two planes here. There's not, and by the way, the taxpayer subsequently sells the plane, just so you know. When you hear the word sale, you think of what code section? 1001, thank you. And the taxpayer sells it for about $35,000 and 35,380 amount realized, code section, oops, 1001, right? Transaction. And just, you know, do the arithmetic. It's about $5,000 loss, right? I'm just going to round 5,000 loss or so. And the taxpayer, being the generous taxpayer, our taxpayer says, you know what? We won't even take the loss. By the way, your intent always goes up when the taxpayer says they're not taking loss, right? Because that, to me, is clear indicia that they have another agenda of like, let's see if we can sneak this one under the radar screen, right? The IRS says, let's treat this as two different planes, okay? Two different planes. Let's treat this as a business plane and treat this as a non-business plane. And the business plane, you know, we take this $54,000 basis and we're going to split it up. 76% pleasure, 24% business. If you do the arithmetic, the business, or the 24% of that, is $14,298.90, and the non-business, or the pleasure part, is $39,974.60. And the depreciation is only on the business side, right? So the adjusted basis here is $520.98. Now the plane is sold. What's our amount realized? It's $35,000, but we got to bifurcate it again. 24% to the business side, and 26,000 to the non-business side. Here. Any loss here? By the way, I just want to call so they're treating it as two planes. Now I just want to call this to your attention. On page 442, excuse me, I don't know why I'm calling 441, page 441, 4 lines down. Remember when we were looking at holding periods and we talked about someone building a 2-story house and they were done 50% That's an actual case. If you look 4 lines down, or I should say 5 lines down, it keeps being off by 1. By Paul B. Commissioner. And Paul, a taxpayer who was in the business of holding rental property for investment, bought a partially completed apartment in May, which he sold more than 6 months later in November. And it goes through about how this was treated as 2 separate pieces of property. I just thought you might find it interesting where the authors came up with their creative holding period question from a few chapters ago. But in any event, here the court treats this as 2 separate planes, right? And the question is, on these 2 separate planes, can we get a loss on the personal? Oh, what code section, Matt, puts the brakes on the personal? Close, but not close enough. David? John? 165. 165, right? Loss must be realized, recognized, and allowed. And if you buy a plane, like a car for pleasure, and you subsequently sell it for loss, can you get that loss, guys? And here, we sold the plane. Our adjusted basis was about 500. Our amount realized is 9,300. $8,800 a gain. Jackie, what's the character
For what? I'm sorry. For a loss.
on the business part of the plane?
I'm not sure.
Luke?
Would be like a, yeah, it's a capital loss.
You're whispering.
Capital loss?
But there's a gain.
Oh, it's our capital gain then?
Would that be right, Jeff? Okay.
1231.
Okay, so what's the character there?
Well, you don't know yet.
You're saying be patient.
Yeah.
Be patient. Would that be right there, Anna? Would patience help here? Anna, would patience help?
Patience.
This is big, this is the first year, yeah.
What about? Just say it loudly.
This is the first year. and it's a
Who
big-
said it's the first year? They've been depreciating it for many years.
It's already the end of the year.
Yeah, for some reason I thought-
And Stephanie, you're great. Patience. Virtue, Jesse, patience. Anyone who says screw patience here? Alicia?
Appreciation and culture.
How about 12:45? Oh man, you guys are gonna ruin my vacation.
Well, that was the next thing I was going to say. That was the next step.
No, that's the first step.
Hold on.
Well, don't you have to know what type of asset it is, and then you would apply the 1245?
You don't have to be patient, Nick. 12:45 grams you. No patience.
Oh, yes, yes, you're right. Yes.
All right, it's good day of mine.
Because it's
But guys, forget that. None of us are going to have a good night in this room, okay? And I need to have a good holiday. And you want to have a good holiday. So together, let's have a good holiday. All right, get down to business. You cannot forget 1231, the peanut butter and jelly. You must remember 1245. Imagine you were telling your supervisor. Imagine you were telling your client. Picture you're telling your client, you're typing an email. Oh, you have a 1231 capital gain, okay? And they're like, yes. And then a week, a month, or worse, on audit, the IRS comes back and says, oh, that's all recapture you, interest and penalties. Not going to be a good day in the office, right? Bad day in the office, I can promise you. Very bad day in the office. Client's not going to look in the mirror and say, you know, my fault, I'll let you go on this one, right? So just be careful, guys. Dangerous world out there. Very dangerous world. I promise you it's a dangerous world. All right? Everyone see what, in nice case, just showing you how depreciation works here. Any questions on the shark case? Okay, so And even though, you know, the taxpayer complained and said, oh, this is really one plane, you took too many liberties and divided it into two planes, the court has no patience. The court said, you know, this is a good way of looking at this, okay? So, taxpayer loses. Any musicians in the room? Thank you, musician.
This is funny guy.
No one, I can't believe in this class, no one played the flute, no one played the harmonica, no one played clarinet when he or she was younger. You yearn to be a tax accountant, everyone here? No, none of that stuff. Serena, you played something?
I used to play the violin when I was little.
Oh, then did you read this case?
No.
I got a treat for you, Serena. You got to read this case. It's all about a violin. Anyone have a chance to read this? Luca, you do? Tell us about it.
So, they bought a violin, which he eventually appraised for $45,000, I believe. And he actually used the violin.
Was this any kind of violin?
No, it was a really nice, famous violin.
All right, this is very
Collector's
famous.
item.
Yeah, very famous violin bow. And what was the issue?
He took depreciation on it after he played it in 4 concerts.
Okay, so he would use it, and does it have a useful life?
No.
No, it appears that it does not, that its value will be maintained. So it does suffer wear and tear, okay? It does suffer wear and tear. It's not like a museum item, but it's not clear that it has a useful life. And the IRS says that it's a sine qua non, that, or an essential feature, that if you want depreciation, you must have a useful life. A predicate to getting depreciation deductions is that there be this useful life. All right, so Luca, who prevails and why in this case?
The tax court prevails because there was no determinable useful life.
That's not because. I would say despite that there, I don't want to say because there is no useful life. Taxpayer prevails here. And the court says essentially on the basis of 2 reasons that are spelled out on page 447. Is that the court looks at the revised depreciation rules and says that essentially Congress wanted to spur economic growth. So when it recrafted the depreciation rules, it downplayed the importance of the useful life concept. So the court read into this policy objective of trying to spur economic growth. And secondly, on page 447, Congress sought to simplify the rules. That it was enough that the item endured wear and tear, you didn't have to have necessarily a useful life. So it sought to simplify the rules, and as long as it was subject to wear and tear, that was a sufficient predicate. On the basis of that rationale, those 2 rationales, the taxpayer prevails. Taxpayer prevails. All right, so the authors are just giving us 2 examples of when depreciation comes into play. Let's look on page 452. If the short quote-unquote divided plan was purchased in the current year and was used for non-entertainment business purposes, with a facility limitation of 274A1B denied the depreciation deduction. And if you buy a facility like a ski lodge for business entertainment, you can't get a depreciation deduction. If you buy for entertainment purposes. But if you buy it for an airplane for travel expenses, not for entertainment, for traveling, this facility limitation would not apply. So the answer to question 1 is the facilitation limitation under 274A1B would not apply to an airplane which is not used for entertainment, but rather was used for transportation. That's kosher. Question 2. Section 263 provides no deduction shall be allowed for any amount paid out for new buildings. Thus, if one pays for salaries or for painting, etc., in the construction of the building, the expenses are capitalized, and the total cost of the building is then depreciated, assuming the 167 and 168 requirements are met. Question 2A says that the company owns trucks that are used during the year exclusively in constructing a new storage plant. Is the company allowed a depreciation deduction for the trucks during the year? And if you recall from Idaho Power, this is a case I believe we discussed before, whatever that cost would be has to be capitalized in the cost of the building. So if the depreciation deductions were $100,000, you don't get to deduct that. It has to be added to the basis of the building. And then if the useful life is 39 years, you have to depreciate it over 39 years. Okay? And if you recall under a NOPCO case, if it were intangible assets and you used in-house people to decide whether or not, for example, a merger was efficient, then those in-house costs would be deductible. So you recall that the authors complained that when it comes to tangible property, it has to be capitalized. With intangible property, you can immediately expense. Question 2D. Are interest on loans connected with property and taxes on the property, which are paid during the construction phase, currently deductible? The answer is no. Code section 263, capital letter A, mandates that those expenses be capitalized, that they not be immediately deducted.
I just had a question. How do we know what the useful life will be? Is that something?
I would tell you the class.
Okay.
So again, Nick was worried about, and rightfully so, but for exam purposes, I would tell you what the class life is, okay? Fear not. Fear, but fear not. Okay? Okay, so.
So I just want to confirm, so interest and taxes are also
Capitalized, yes. Interest and taxes are also capitalized. And the authors beginning on page 452, again, we'll go through our depreciation. You guys have to review this yourself. I can't read this. You don't want me to read it to you. You're graduate students, so you don't need to hear me read this to you. But if you haven't gone through this or work is crazy, remember, good news, Thanksgiving's coming up, and I can't think of a better way I would rather spend it than immersed in tax. And hopefully you guys share that, and you too will immerse yourself deeply in tax and make sure you catch up if you when you get a chance. And please read and reread this, okay? Now, two or three things I'm going to call your attention on this segment of the chapter. Item 1. There's something called Code Section 179, bonus depreciation. Okay? As we all know, Congress loves sound bites, right? So they want to, quote unquote, help small businesses, right? That's a mantra that you hear among many politicians. And what they say under Code Section 179 is, small businesses, they don't have the accounting skills, they don't have the professional skills to deal with depreciation, keeping books and records. You know what? And this may be extended big time, like I said, under the new administration, is that under Code Section 179, you can expense the first $500,000 of cost with items you newly purchased items, not real estate, that you place into service. Okay, Code Section 179. But there's a cap. And you guys saw this in Code Section 195. You remember? Code Section 195 allowed the first $5,000 to be expensed immediately. But once you exceeded $50,000, for every dollar you went above $50,000, you lost an immediate dollar deduction. The good news about the code, or the great news about the code, is the more you do, the better you become. Having said that, here, if you exceed $2 million of property you put into service, for every dollar you exceed $2 million, you lose a dollar of immediate write-off. So, if you put $2.1 million of property into service, what's your allowable 179 bonus depreciation? 400,000, right? Because you exceeded $1 million by 100,000, right? So that means you only can use $400,000. Jackie had that perplexed look. Got it?
No, can you repeat that? I'm sorry.
You have $2.1 million of property you place into service 2016. You exceed $2 million by 100,000, as I checked. 2.1 is 100,000 in excess of $2 million. For every dollar you go above $2 million, you lose a dollar of immediate deduction. We went over by 100,000. 500,000 less 100,000 is 400,000. So we can only get a $400,000 bonus depreciation.
Under 179.
Under 179. Okay? Say again, say again, Ashley?
It says 25,000 in the case of taxable year beginning after 2000.
Yeah, but the rule has been changed and made. Are you looking at an older edition of the book?
I don't think so.
Are you looking at the 8th edition? 18th? What edition of the book do you have?
I got the one you corrected.
18th edition?
I got an older one, yeah.
Okay. The new rule is 500,000. Okay, Congress made that permanent in the last tax act. It used to be 25,000. Congress, again, very generous. We'll see Congress may be even more generous in the months to come. Okay? And then, that's bonus depreciation. Then we have additional depreciation. Congress wants to juice up the economy. Code Section 168K. 168K. Allows additional depreciation. Additional depreciation. Currently up to 50%. Again, this does not apply to real estate. Up to 50% with no limitations, no dollar limitations of whatever is purchased in 2016 to be written off immediately. 168K, very generous depreciation allowance. Yeah.
So, you can take both 168 and 179?
Yes, we're going to see examples when you can take both 179 and 168. Congress can change it, but for the time being, I used to think Congress was going to make it more restrictive for trying to make sure that the country had some revenue, but I'm not so convinced now.
Any depreciable property you buy in 2016?
Not real estate.
Not real estate, besides real estate, you deduct 50% immediately?
Yes, you can deduct immediately 50% of the purchase price. How do you?
What's going to happen in year 2 under 179?
What's going to happen in year 2? Nothing. 179 is only an acquisition.
179. So you
It's
don't have
not
to
applying
take
in year
allowance?
2. What?
That's going to apply in year 2?
Doesn't apply any other year than year one.
But in year 2, you can choose with the balance.
Yeah, the balance, the adjusted basis is gonna be a lot lower. Right? Now, Congress gives us code section 179, gives us 168, the bonus depreciation, right? But it also, bear in mind, 168K, code section 280, capital letter F. Code section 280, capital letter F, this is on page 458. With so-called listed property. So-called listed property. Certain rules apply with listed property, which include luxury automobiles, computers, and things like that. That there's restrictions on how much depreciation you can take. And if the business use is 50% or less, you must be on the straight line method. Okay? So we have two positives for taxpayers. The two positives are listed property, is code section 179 bonus and 168K additional depreciation. We have one thing that we have to be careful about. Code section 280, capital letter F. At the very end of page 460, 461, the authors describe the amortization of intangible property. Amortization of intangible property. And the authors discuss the fact that intangible property, two things, generally amortized over 15 years. 15 years. And the obliquely on page 461, the first full paragraph on page 461, there's a discussion under the paragraph that begins under the provision. 4 or 5 lines down, it says, with the month in which the asset is acquired. The month in which the asset is acquired, that's an oblique mention to the convention of the full month convention. So you get a full month of depreciation for whatever month you acquire property. So beginning on page 462, there's this problem. Let's look at problem 1, and then we'll take a break. Let's look at problem 1, and then we'll take a break. Let's look at problem 1A. Someone acquires property for $300,000. The purchase is made from an unrelated person. The equipment has a 6-year class life. Nick, fear not, I would tell you the same thing. And if it's 6-year class life, we know that it's 5-year recovery period. Depreciator plans to use the equipment for 7 years. We don't care. Excuse me, my voice is cracked. We do not care. And expects to have a $30,000 salvage value. And I know I'm looking. We don't care, right? We do not care. 168B, we do not care. Depreciator is single, calendar year taxpayer. She uses equipment only in her business. What kind of asset is this? Say again, Annetta? 1231 asset, right? Is it capital or non-capital, Annetta? Say again?
We'll have to see.
We don't have to see anything. Say again, Nick? You're killing me. Code section 1221, it's a non-capital asset. right? 1231 assets are better than capital assets. It is not a capital asset. It can get capital gain, but it ain't a capital asset. Big difference. Right, Busto? Guys, the fate of my holidays in your hands. Right now, it's not looking promising. But I'm sure with Thanksgiving coming, you guys will turn it around and make sure you master this stuff. All right? No hope, on time, effort, and energy will get you to the promised land. All right. Compute the amount of depreciation, assuming 168 a day, the taxpayer elects out. We're not going to worry about 179 for now, okay? So we just want the general rules, okay? So suppose the taxpayer here purchases this equipment, and we just want depreciation. They elect, we're told here, straight line.
Okay.
So column 1A, we have year, we have percent, we have amount of depreciation, and we have the new adjusted basis under 1016. How many years will we depreciate this property for, Jessica?
Well, it's gonna be over 6 years.
6 years. Thank you, Jessica. Music to my ears. I can feel my holiday getting better. Because of the half-year convention, it's going to be over 6 years, even though it's the recovery period over 5. So, the first year, Matt, David, what do you say? What's the depreciation the first year? Again, Matt? Would be the depreciation. Equipment here costs 300. David, you agree? So how much would you multiply? What's the percent depreciation first year?
Oh, it's a straight. 20.
Say again, David?
20.
Why 20?
It's a 5-year property.
See, David's doing something he's doing tonight, but he won't do on the exam. What are you forgetting? David's forgetting to apply the convention, right? David, did you forget to apply the convention?
It sounds like I did.
Well, you just said 1/5, right? David knows his straight line depreciation. It's 1/5, right? 1/5 last I checked is 20%, but it's the half-year convention, so you only get 10%, right? David? That's 30,000, and that's 270,000 adjusted basis, right? What?
Which convention was it?
Half year, normal generic half year convention.
Oh, so
The property was placed into service in January. David, Matt, what about year 2? What percent?
That's the full 20, right?
Yes, no question mark, 20. And are you going to be surprised? I hope I didn't give away any secrets here. It's not like Hillary's server. Bring it on, isn't it? And then I heard silence.
No. You just don't have to look at the chart.
Everyone good? Everyone feeling good?
It should be the additional of the percentage come up to 100%.
Gotti, you're having a conversation with yourself. I'm not sure why.
100%.
Right, question B. Depreciator uses the accelerated method. Accelerated method. So how many years? Jessica.
Same. Over 6 years.
What was that, Jessica?
Over 6 years.
Absolutely, 6 years again. All right. So this time, let's go up. Let's go. James, what were you going to say?
Just want to interrupt that.
Say again?
What's going to answer?
I can't hear you.
What's going to answer the?
Go ahead, James. Go for it.
Would it be 50?
So again, and Zach, see if you agree. So say again, James. So what percent should I fill here? James?
50.
50. Zach, agree or disagree?
Yeah, I agree.
Why do you say 50?
Because of, 168K.
But we're electing out of 168K. James, we're electing out of 168K. If we're just doing normal depreciation, we're not getting 179, we're not using 168K. So what's the normal depreciation? Double declining, but so just tell me what I'm going to use here. What percent? Nice. What percent? 20%, right? Normally, 1/5 times 2, right, is 2/5 or 40%, but David, we wouldn't let the half-year convention go by, right? Of course not. So it would be 20%, right? 20% would give us 60,000 in depreciation, and that would reduce our basis to 240,000, right? Year 2, what percent? 40%. Music to my ears, right? 240,000. That's 96,000, right? Year 3, 40%. 57,600. 86,400. Year 4, 40%. 34,560. 51,840. Now, if we keep using 40%, what's going to happen? We will never get to 0. Everyone agree? We will never get to 0 if we keep using 40%. What will give us more depreciation if we use 40% for a straight line in year 5? And this is, most times the computer will do this for you, but you can do it by trial and error. Which one produces the greater depreciation? Straight line or 40%? Straight line depreciation, how much time is left on the time horizon? A year and a half, right? Year 5 and year 6. We have 1 year and 5 and a half year and 6. Everyone agree? So if you have 1 year and 5, isn't straight line when you use 1 over 1.5? Because isn't that the total time period? Is 1.5 years is the denominator? The numerator is 1 year. That 1 over 1.5, which is equal to 2/3, 2/3 of the remaining basis under straight line is going to give us more depreciation. So straight line here will be 34,560, 17,280. We have a half year, right, for year 6. And that's just going to be the remaining. And this will be 0. Here's my recommendation, guys. Luca.
Was that just a coincidence between year 4 and 5, or is that always how it's going to work out?
In 5-year property, you'll always begin straight line in year 5. Here's my recommendation. Check these numbers out. Okay, try to follow along. Follow the Clusto method, get Monster during our break. And I'm gonna have some fun, and I'm gonna see if we can get any depreciation if we buy and sell, right, James, in the same year? Right, Wes? I'll see if I can do a quick search and come back with authority, okay?